Recently, the government announced their changes to income tax brackets and certain benefit and tax credit amounts for 2025. For next year, many of these benefits and tax brackets are going to go up by 2.7% to coincide with inflation over the last year. This is generally a good thing, but there's still a catch. Some Canadians might still end up paying a bit more in tax or receive smaller benefits than they have in years previous. Some of the items that haven't changed have stayed the same since the 1970s. So in this video, I'm going to go over all the things that are going to be changing for 2025, but perhaps more interestingly, the things that aren't changing. Okay, here we are on the Government of Canada website, and as I mentioned in the intro, the index that's going to happen with the vast majority of these benefits and tax bracket thresholds is 2.7%. Last year is 4.7, and the year before that is 6.3. You might say, oh my goodness, this is getting worse. It's like, well, no, this is just tied to inflation. So this just means that inflation is closer to a normal level, kind of like what we saw in 2022. Before that, the inflation amount and the indexation was quite a bit lower. This is just to coincide with what's going on in the world. They don't really take a subjective approach to this. There is an objective calculation that happens with the index amount. So as it relates to tax brackets, this is just the federal portion. Every province also has income tax, and their bracket thresholds are different. The vast majority of provinces will increase their tax brackets along with inflation, but that's not always a universal situation. In some provinces, they have increased some brackets with inflation, and sometimes they haven't. And so take a look at your province specifically when they announce that data for where you live. So the big thing with tax brackets is that everything is moving up 2.7%. So what does this actually mean for you? Well, if your income stays exactly the same, you'll pay a little bit less in tax. And you might say, oh, fantastic, that's great. I'd rather pay less tax. But if your income stayed the same, but inflation was 2.7%, that means that you can consume, in theory, 2.7% less than you did the year before. I know it's not exactly the same, but that's kind of the theory there. So the idea that tax brackets move up with inflation is just to keep you level, not to give you some sort of bonus or anything like that. So again, the way that tax brackets work is that you only pay that rate of tax on amounts above that threshold. So say, for example, you made $150,000, that would put you in the 26% income tax bracket. So that's on amounts above this threshold here. That doesn't mean that you pay that rate of tax, so 26% on every dollar. No, it's just on amounts above 114. Then you'd pay 20.5% tax on amounts above 57,375 up to 114. If this whole concept of tax brackets is new to you, I'd recommend you go back and watch my video here where I explain a little bit more about tax brackets. Now from here, this is where things get a little bit more interesting. So these are some non-refundable tax credits that will reduce the amount of tax that you actually owe. So most people will qualify for this basic personal amount. So everybody gets a certain amount of income tax-free. Back in 2023, this number was nice and round at $15,000. That was great. But now that it's gone up, it's tougher to remember. So now for 2025, the basic personal amount is going to be $16,129, except for the very high earners. Then there's a number of other tax credits that you might qualify for. So if you're over the age of 65, you qualify for the age amount, and that is now up to over $9,000. The disability amount has gone up as well. And for people that are supporting children with disabilities, even the old age security clawback, is what we often call it, and most people call it a clawback. They call it the repayment. That threshold is now over $93,000 for 2025. If you work in the trades, the deduction that you can use to pay for some of your tools has gone up by just under $40 a year. The GST tax credits that you qualify for based on your age, that is going up as well. The tax-free savings account is an interesting one because technically it is indexed to inflation, but they round it to the nearest $500. So again, for 2025, it's going to be $7,000, just like it was in 2024. The Canada Child Benefit even will go up, and these are the base amounts. The calculation is a little bit convoluted here based on how much household income you have, how many kids you have, and what age they are. But all of the different factors at play with the Canada Child Benefit are indexed with inflation as well. So it'll allow you to earn more income before your benefit is clawed back and the benefit itself is increased along with inflation. This is pretty standard. These things happen every year. It's good to know, but it's not really going to impact things too much. But what you might not be aware of are all the things that haven't changed in a really long time. And if you qualify for these benefits because they haven't increased with inflation, that means that they've gotten progressively worse for you every year that they haven't changed. So let's get into these right now. The first one is the CPP Death Benefit. So this means that when you pass away, there is a lump sum benefit that's provided to your spouse or a beneficiary of $2,500. And this amount has not changed. It hasn't gone up. CPP is indexed with inflation, but the value of the death benefit has stayed the same since 1997. So this amount is still $2,500 for 2025. Next is kind of like a tax bracket, but it's the withholding tax system for registered retirement income funds, or RIFs. So a RIF is the second half of an RSP once you start taking money out of it. And you pay withholding tax, meaning you're prepaying taxes that you're likely to owe on that income based on how much you take out. So every year you have to take out a minimum amount, but withholding taxes are applicable on the amounts above the minimum. If this is all Greek to you, I've got a video here that you can watch that explains withholding taxes a little bit more. But the rates of withholding tax that you pay on amounts above the minimum have stayed the same since 1978. This is crazy. And so now the withholding tax amounts are virtually meaningless because inflation has made the dollar amounts almost irrelevant. And so the regime that was in place in 1978 is still the same now. So the withholding tax rate that you pay on withdrawals up to $5,000 above your minimum amount from your RIF is 10%. Then you pay 20% between $5,000 and $15,000, and then 30% on amounts above $15,000. This means nothing, and it's just an annoyance, but it's something that we have to do. Still, every financial institution has to deal with this, and the calculation stays the same. However, the amounts that you're withdrawing from your RIF, since they're all taxable, many people will still have to pay additional taxes when they file their taxes in the new year, because this withholding tax amount is completely irrelevant to the amount of tax that you might actually have to owe from the money that comes out of the RIF. Everything gets sorted out around tax time, but it's just an annoyance, and it could very easily be indexed to make sure that people aren't getting confused at the very least around how much tax they actually have to pay on the amounts coming out of their RIF. The next one impacting retirees is the pension income amount. So every year, if you're over 65, it's get a little bit complicated if you have certain types of pension income. Broadly speaking, though, if you have pension income over 65, you can get a $2,000 tax credit to reduce the amount of tax you pay as a retiree. This is great. However, the pension income amount has never changed. It's always been this $2,000. So every single year, especially years where we have inflation and lots of it, this benefit gets worse on a relative basis. Yes, there's still a benefit there for sure, but because it's not indexed, this benefit gets worse over time. Now, for people who have kids or grandkids and you're using an RESP, there are grants available for contributing to the RESP, and the government will match up to a certain amount. And that amount is called the CESG, the Canada Education Savings Grant. That amount is capped at $7,200 per child for the lifetime of the plan. That amount has not changed since 1998. Believe it or not, tuition costs have gone up a lot since 1998. So parents have to come up with more money for their kids to go to school, or kids have to work more to be able to pay for their higher levels of tuition. If you were born closer to 1998, that grant money went a whole lot further than it does now. It's still great. It's still an awesome program that allows for some additional savings to be built up on behalf of a child that's going to go to post-secondary school. But because it's not indexed, the benefit decreases every year along with the inflation rate. Now, long before a child can go to university, oftentimes these days, kids are in daycare. And so there are childcare expenses that can be used as a deduction against your income. However, the amount that you can use as a deduction hasn't changed. The cost of daycare has gone up. The cost of everything else has gone up, but the deduction that you can use to offset those expenses has not. That has stayed flat, and it all depends on your children's situation and how many kids you have, but the childcare expense deduction has stayed flat and hasn't increased along with inflation either. Now, this next one is a new one, but we haven't been given any sort of indication from the government that they are going to index this amount. It's the FHSA contribution amount, and that is $8,000 per year for a lifetime maximum of $40,000. And up until this point, we haven't heard any rumblings of that changing anytime soon. So if you qualify to open a first home savings account, or your kids do, I'd recommend that you do it now, because since it's not indexed to inflation, the benefit relative to a previous year is going to be worse over time. So the sooner you can capitalize on that benefit, the better. So if you're wanting to take some more action on your finances and perhaps reduce your tax bill for 2025, I think you should watch this video next.